Hello and a warm welcome to Personal Finance. I'm Gugulethu Cele. Tonight I'm joined by Lance Solms, who's the head of Itransact, and that's as we take a look at investing in exchange-traded funds, but strategically so to make sure that you ignore the market volatility as well as noise and ensure that you diversify the opportunities present when it comes to savings in exchange-traded funds. Good to have you with us as always, Lance, and thanks for making time.
Thank you.
Let's pick up on some of the typical myths associated with exchange-traded funds. I guess for the audience members who don't have in-depth understanding of ETFs, perhaps if you can give us provide us with a refresher with regard to this.
Okay, the ETF is simply a unit trust that is listed on the Johannesburg Stock Exchange, and the ETF generally tracks certain indexes, and the most common and easy one to understand is the top 40 ETF, and really what that does is it tracks the top 40 companies, South African companies for you, on your behalf without you having to figure out which are the top 40 companies. So with buying one share on the stock market, you have access to the performance of 40 companies all in one go. Exactly.
Now, given this opportunity to invest in so many different companies, there are some myths associated with ETFs and this passive form of investing. Okay, to decipher some of them?
Yes, absolutely. I mean, people have a misconception of passive investment, thinking that there's no one driving the car. It's like sort of like a driverless car, but in actual fact, there's a lot of activity behind a passive fund, and that's in designing the mathematical algorithms that really go and penetrate the market and find out, for example, which of the 180 odd companies listed on the Johannesburg Stock Exchange, which of those 40 are the most powerful companies to invest in, and that gets done on your behalf very cheaply. It doesn't take a lot of rocket science or a lot of people to do it. It just takes very clever people behind the computer algorithm. You've got many other ETFs. You've got ETFs that track the best property stocks in the country. You've got ETFs that track the best overseas companies, for example, as well. You've also got ETFs that track companies in South Africa that pay the best dividends. So there's almost a menu for any investor to pick what kind of strategy they would like. And it's all done very cheaply by a computer algorithm. Remember, all it's doing is it's picking certain targets out of a whole basket of targets. And generally, they just look for the best performers, which is good for you and I as an investor. You mentioned a lot about volatility, and people would say that yes, there is risk in just investing in a single stock ETF, for example. But just remember, as an ETF moves down with the market, it immediately moves up with the market as well. And that's what a lot of active managers would tell you that they wouldn't be able to do. So although they would have more sort of control over market volatility, they've also got less control when the market recovers. So exchange-traded funds react directly to the market. And that's one part of an ETF that always gets ignored. You know, everybody looks at the downside.
Exactly.
Very few people look at what happens on the upside.
I'm glad you mentioned that, because perhaps we can draw an example from the most recent market shocker, which was the Brexit vote.
Yes.
And there was a significant sell-off in major stocks across the globe. With ETFs, did we see a similar reaction, or perhaps losses that weren't that substantial?
They weren't really that substantial. It depends where you were invested, obviously. If you were in an ETF that was invested looking at European companies, then yes, definitely you were affected. But a good example for a South African investor, you have some ETFs that cross multiple asset classes. Now, those investors were hardly affected by Brexit. In the most severe case, there was a 2% drop in those portfolios versus the South African market drop of 6%. So there's a classic example that ETFs are not as volatile as what people may think. And again, it's a long-term investment instrument, and noises like Brexit and that, we'll only see Brexit play out in the next year or so. To look at it on the day or on the week is really not a good idea. But the fact of the matter is that if you were spread across various asset classes, you wouldn't have even felt Brexit. It's a mere bump in the road.
And isn't that the point? Because if you are invested in ETFs, it's most definitely for the long term. So these small blips that take place will naturally be evened out in the long term?
Absolutely. And that's for any investment, I guess, it requires investment discipline. These scares that happen in the market should typically be ignored. If you've got a 10 to 15-year investment horizon, this is nothing compared to the greater scheme of things, and they should typically just be ignored.
Talk to us about exploring offshore opportunities through ETFs, because so often we hear about these stocks like Facebook and maybe Google and Amazon that we'd like to get exposure to, but not quite certain as to how to do that via ETFs.
Well, it's very easy for a South African investor who wants to be exposed to global markets. They can go and find a company called Deutsche Bank online, the Deutsche Bank ETF investment plan, and there they can select a whole selection of exchange-traded funds bought in South African rands and exposed to offshore markets. And they've got a fantastic range of products. You and I can go invest into a world product that invests in the top 1,000 companies worldwide. So that's an amazing product. I mean, you're getting access to Apple, Microsoft, Honda, and all those companies. I'm not directly owning the share, but you're getting, your rand has been exposed to the profits made by those companies. Or you can go more focused. You can go look at Europe, for example, especially now with Brexit. Some people may think that there is value in Europe and stocks are cheap. So you could go get a UK ETF, for example, or you can get a USA ETF, or if you really want to, you can go to China, or you can go to Japan and get ETFs there as well. So really, again, a great selection for investors. And you can access these regions and areas of the world at extremely competitive prices, far lower than your typical active managed fund, for example.
So true. Talk to us about the take-up as well that we've seen with ETFs, and in particular from the perspective of tax-free savings accounts, because I think a lot more consumers have become open to the fact that it doesn't just need to be opened up with a bank and get typical interest rates there around 5% or so, in line with some of the current targets.
Well, the ETF market, as you know, is quite new to South Africans. It's only been around for the last couple of years, but it's grown very quickly to the point that if you think about it, there wasn't, in the year 2000, there wasn't one ETF available in South Africa. And now you've got over 50 of these instruments and a market of about 100 billion South African rand, which is significant. Thinking of a lot of that money hasn't been new money, it's been money that has come across from active management, from customers who've realized the value in exchange traded funds, that they do give good returns at a hell of a lot lower costs than their active counterparts.
Yeah. Talk to us about costs and fees, because that's always a sore point sometimes for some investors who tend to shy away from ETFs.
I think before one discusses any sort of product, an investor must understand the effect of fees, because it doesn't matter what you're buying. First, one has to understand what costs mean. And costs destroy returns, no matter where you are. And the easiest way to calculate a cost is when you hear of 2%, your costs are 2%, just for example. You need to calculate it against the return of the product you want to invest in. So if your product only returns 10% per annum and your costs are 2% per annum, your costs are in fact 20% per annum. Because 2% of 10% is 20%.
Goodness.
And a lot of people miss that. So when you're looking in the exchange traded fund market, you can buy a top 40 exposure to the top 40 at a 15th of a percent. So that's 0.015%, a 15th of a percent, which is very, very cheap. That gives you, and that plugs you directly into the economy of South Africa. So those ETFs are producing the market return, which haven't been that all good over this last year, as we know. But the fact of the matter is, your costs are still low. As opposed to you invest into some other instrument that wasn't passively run, your costs would have been far higher with still the same market return.
Sure.
So understanding the effect of cost is absolutely crucial for investors. But ETFs solve a lot of those problems in terms of costs.
Exactly. Just before we do get our takeaway points though, is it possible for us to compare performances of various ETFs? And if so, where do we find this information?
You'll find that information all over. If you go and Google South African ETFs, you'll find various websites and platforms and that'll provide that information to you, including our platform. It'll provide cost comparisons, and you can actually see what's going on. From a return point of view, all the returns are there. I must caution you though, you'll see 3 to 4, or sometimes up to 4 different ETFs are all the same. For example, top 40. Now the question is, which top 40 do I choose? And there the answer would be the cheapest top 40. A lot of them have got different prices. They're all accessing the same market. You're all tracking the same market. So just cautioning investors again, just to look a little bit deeper than your most well-known brands in South Africa. There are other brands that track the same indices for a lot less.
I also wanted to get your feedback on the uptake from millennials as well as business people, because those who are quite au with the market do and try to get some exposure to ETFs, but with younger ones who are trying to get involved in the investment landscape, have we seen an uptick there too?
It's very difficult to actually determine that. I know from our platform perspective, yes, a lot of young people do invest in exchange traded funds, not necessarily because they are online or anything. It's just that they understand the effect of costs a lot better, and they can access information a lot better. Most millennials don't feel the need for a financial advisor just yet, but as we all get older and as we all have more and more responsibilities, one starts asking more questions. A very good example of the wrong questions to ask a millennial is, what do you want to do or when do you want to retire? and they don't respond well to those questions because they're not going to be able to retire in the traditional sense of the word.
That's true.
One should be asking them, what other university degree are you going to go and study for your second job? And that requires saving. So I think youngsters need to save for their second career rather than retirement, and that's probably another question set that should be asked that people aren't addressing for the youth of today that may live to 150. They're not going to retire at 65, they're going to have to go back to varsity. So the question is, do I need to save for another degree?
Oh goodness, you're making us ask very difficult questions here, Lance. But let's get a quick recap though now on some of the key takeaways of tonight's discussion. Lance, for those who caught the tail end of tonight's conversation, what is it that we need to bear in mind as we wrap up tonight's talk on ETFs?
Good. I think you need to be diversified. So when one's looking at an exchange-traded fund strategy, one needs to look at a balanced portfolio of ETFs that you've got cash, property, South African equities and offshore equities, and that should take a lot of the sting out of any asset class performing better or worse than the other one. For example, those people who were just in equities felt Brexit. Those who only had partial exposure to equities but were also in properties and bonds and cash didn't really feel Brexit. And the other big takeaway is cost. Really examine those costs. Understand that costs are a percentage of the return. Remember, if your return is 10% and your costs are 2%, it's actually 20% of your return as opposed to 2%. So really study those costs and also have a look at different ETFs that have got the same name. A lot of them are run by other companies that may not be as well known as the traditional guys who sell the ETFs, but they track the same markets at significantly lower costs.
Exactly. Lance, thank you so much for your time and providing us with some feedback and updates with regard to the uptakes of exchange-traded funds for savings vehicles. Well, that's where we wrap it up for tonight's view of personal finance. A big thank you once more to Lance Solms, who's the head of Itransact. Now, do remember that we want to get your feedback and your insight into your experience investing and saving through ETFs. You can tweet your comments to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu. Until next time, happy saving, everyone.